Assalamu alaikum. How are you, friends? Hope all of you are doing great. So, today we are starting with nature and purpose of financial management. This is the introduction of financial management, the first ever chapter in financial management. So, before I start the whole syllabus, I thought of giving a summary of the whole syllabus in section A, that is the financial management function, right? In section A, the main is financial management function. Under this, we are going to cover all this, as you can see in this chart, starting with financial management. Now, this financial management is divided into how many parts? 5. It is divided into 5 sections, right? The nature and purpose of financial management, as you can see it's on the left, nothing else is there. That is the only branch. Let's go to the second branch. And this topic, by the way, this video is only discussing about the nature and purpose of financial management. That is the first section under financial management. Because without understanding what is the purpose of financial management, why are we studying this financial management, what is financial management all about, it's no use that I teach you all the theories and concepts of financial management, right? That is the basics. First you have to understand that, right? So this video is going to be really easy, right? It's a short video. Second, the second section is the relationship between corporate strategy and corporate and financial objectives. This will be in my next video, the upcoming video, right? We are going to discuss that. So in that, you can see it is divided into financial objectives. Financial objectives is again divided into 3 subsections. What is it? Shareholder wealth maximization, profit maximization, growth in EPS, earnings per share. We are going to touch all these topics one by one, right? I'm going to cover everything. Third, stakeholders. Okay, when I'm saying third, fourth, fifth, do not get confused. I'm moving across and then I'm going downwards from that, right? So stakeholders and their objectives. So stakeholders and their objectives is there we have stakeholder conflicts. Now, why stakeholders in financial management? The reason why, because financial management, to manage the finance, we have to deal with various stakeholders, right? No matter whatever it is, whether it's financial accounting, whether it's management accounting, whatever it is, whatever the role you are given, you have to deal with stakeholders, right? Tomorrow, if you are a finance director or a finance manager, right, you have to deal with the stakeholder. Why? Because your objectives, financial manager, their objective, the financial objectives might be different from the company's objective. Maybe you want something else. Maybe the company CEO wants something else. The objectives are conflicting there. That's why stakeholders is very important concept in financial management. You have to know their objectives. You have to know who are the stakeholders because you have to deal with them. Because as a financial manager, you have to find a way to work across your stakeholders in such a way that conflicts are minimized. It cannot be eliminated because, as we know, the rules is hard to manage humans, right? You can manage machines, robots, but not humans, because humans are with emotions and they have their different values. You have your different values. So you cannot eliminate it, but you can minimize by using certain strategies. We are going to learn it there. That will be the third part of Section A. Fourth, the role of management and goal congruence. Right? The role of management and goal congruence. Very important. You have to do a goal congruence. Right? There we are going to study agency theory. Now this agency theory, you must have studied it in your F1 paper. The management in I kind of forgot the name of the paper, but it's management accounting something. You must have studied the agency theory. But if you haven't, then don't worry. In this financial management, I'm going to take you through agency theory. It's nothing. It's just that a principal means the owner is hiring some managers who are agents. They work on behalf of the owner or the shareholder, the manager. That is known as agency theory. There's a relationship between the owner and the one whom you have hired as an agent, the shareholder and the manager, right? So in agency theory, managerial reward schemes. All this you will find is very familiar and is very similar to what you have learned previously. So we can quickly go through this, right? It's not too much of finance in that financial management stuff. These are like all your previous studies. So we can quickly go through this, right? You might be wondering why it is here included here also. What is the importance of it? You will understand when we come there, right? Let's not be too quick to judge now. Why agency theory? Why agency theory? Because you are expecting this is financial management is all about finance. So let's not be too quick. Once we go there, even I will explain you why it's important. You yourself will understand the importance of it. Next, we have corporate governance code. In SBL, we have this corporate governance code, right? And also in your F1 paper, corporate governance code. Very important again. Because as a financial manager, financial director, the financial management staff, they have to follow this corporate governance code. It's everywhere, wherever you are, whether you're an accountant, whether you are a finance manager, whether you are a financial accounting, management accounting, whoever you are, you have to follow the corporate governance code. That's why corporate governance code is so important that it is included in all the ACCA papers. If you see, corporate governance code will be there. Next, the last branch, the last towards the right, you can see this under financial management is not for profit organization. That will be the fifth part, not for profit organization. Because financial management is not only for profit organizations, we also have it for not for profit organization, right? There we have to know how to plan and we have to set objective, because there in not for profit organization, the way you plan and your objective setting is different compared to profit organization. That's why we are studying it in detail there. And then value for money, very important. Some of these are very similar, so if you want you can skip this video and then you can go straight to the next video. But for the one who does not have the background of this, who is starting financial management for the first time and who does not know all those things, then I recommend you to watch this video till the end. Next, nature and purpose. So what is nature and purpose of financial management? If I ask you, let me tell you or explain me in one sentence, what is financial management for you, right? Now don't tell me that managing the finance is financial management. I mean, come on, that's, you know, it's just you're twisting the word, switching the words here to there. Okay, so financial management. Now, as I proceed with the definition, if I come across, right, whenever in my video, when I come across or I give a definition or some features or advantages or disadvantages, please note it, especially the bold words. Why? Because even if you don't have to write what is financial management, like, but in your MCQ, multiple choice questions, right, section A or section B, you might get this. You will get this. So you have to be very specific with the words. You have to know the words there. Because one word is missing, your answer might be wrong. So for section A, you have to read the whole syllabus, so each word is very important, right? Now financial management is concerned, I have underlined in bold. The reason is these are very important words, keyword, because they might give you an MCQ, what is financial management all about? So they will give you the 4 options. You have to know what are the things included there. So financial management is concerned with the efficient acquisition and deployment of both short and long-term financial resources. See the word, both short and long-term. MCQ, they might ask only short-term financial resources or only long-term. Then if you write that answer, you will be wrong. Why? Because it's not only short or only long. Both short and long-term financial resources to ensure the objectives of enterprise are achieved. This is the definition of financial management. What is the purpose of it? What is it? Next, decisions must be taken in 3 key areas. Now, your syllabus of financial management is based on these 3 decisions. Whole syllabus, if you see, whether it's risk management, whether it's investment appraisal, whether it's business finance, right? Whether it's your cost of capital, everything is based on these 3 decisions. So, these 3 decisions, you have to know it. It comes as MCQs regularly. What are the 3 key decisions. They might give you 5, 6. They might tell you to select 3. So you should be able to know it. Decisions must be taken in the what are they? First, investment. Investing, or you can say investment. It could be investing decisions. As a financial manager, number one, investment decision. Where to invest, how to invest. You will be presented with range of projects. A company and organizations will be presented with lots of projects and opportunities. You cannot go and invest everywhere. You have to see whether it is beneficial for your company or not. You have to do that cost benefit analysis. There you are going to learn investment appraisal, all those things. So both long term investment. Now see, the word long term is very important when it comes to investment decisions. Investment decision means it's not some short term day to day decisions you are doing. That's a long term decision. And long term decision, you cannot reverse it. The effect also will be more on the company of that long term. If the long term decision goes wrong, company will suffer. Right? That's why investing decision is so very important for a financial manager, because it's for long term. Right? Long term investment in non current assets and short term investment in working capital. So your working capital management, we have section, I don't remember the section E or D. One of the section is on management of working capital. The other one is investment appraisal. So these two sections are linked with this decision. Can you see how your whole syllabus has been built on these 3 key decisions? All the chapters which you have, right? Syllabus, there are 7 sections. Section A to G. This is section A. So section A is the foundation, is the base. Rest all, whatever section from section B onwards is based on this 3 key decisions. So investing, 2 chapters we have, working capital management and investment appraisal. We are going to study those in detail later in those sections. But you have to know in this chapter that the important decision is investing decision. Where to invest. Next, financing decision or finance decision. As a financial manager, you have to know from what sources you have to finance. What are the funds? How can you raise the funds? Let's say, for example, you have to build a factory. Okay, you want to build a manufacturing factory. You want to manufacture, let's say, chairs, right? Chairs. You want to manufacture some chairs. Let's say the cost will be around 1 million. Now, you don't have that 1 million. How will you? How are you going to do? Raise that 1 million. You need that 1 million, then only you can build the factory, and it's very important for you to build that factory. Otherwise, you cannot do the manufacturing of chairs, because that's like your main business, production of chairs. You can take a loan from government, right? What else? There are so many sources of finance. We are going to learn it. So that sources of finance: long term, short term, medium term, hire, leasing, bank loan, overdraft, trade credit. All the sources of finance we are going to study in this section, finance. So financing decision is another key area. This is the second. So first we studied investment, second finance. What is third? Third is dividend. Dividend is very important in a company. How you are going to allocate the cash to the shareholders. Please understand that I underlined or highlighted the word shareholder. Why? Because dividends, whom will you pay? Shareholders only. You will not pay dividends to debt holders. You will not give dividends to the bank or your creditor. You will give it to shareholders only. Right? For MCQs, this might come. So that's why word is very important. And how will the value of the business be? See, because of dividend, we know that through, right? Why value of business will be affected? Why did they say this? Value of business. What dividend has to do with the value of business? Please question. Don't just try to memorize something just because it's given. Okay, it is like this only. Don't assume. Question why it is like this. Okay, because the moment you question yourself, you will try to work on the solution. The answers will come to you. Some of the other answers you will get it. That's how you learn. That's how I learn. When I have to learn something new, when I'm presented with some new information, I never go by it just by reading. I never agree until I do my own research and come to a solution. I ask, why is it like this? Why is it like this? Why? So build this habit of asking why. Now, as a student, if I'm reading this, okay, I will not just read, okay, how cash flows will be allocated to shareholders and how will the value of business will be affected by this, okay, finish, next chapter. No, until I find that how dividend, what is the link between dividend and value of business, I will not go to the next one. That is the technique, that is the way I study. And that is the way someone should study. That is known as effective study. Because until you don't know that, that will be in the back of your mind. Next time, somewhere, you will struggle for this thing when dividend comes. Okay, so let me tell you briefly. Okay, I'm not going to go in the depth of this now, because when we are studying that chapter, then later we can relate. Because we, for valuation of a business, when, right, we have a section on business valuation. There, when we have to value business, dividend growth model, we are going to use dividend valuation model, dividend growth model, right? That is known as dividend growth model. The formula is given. So based on that, we are going to value the company. That's why if our dividend is changed in the dividend growth model, what happens? Value of the company also will change, because based on that dividend growth model only we are valuing the company. That's why value of the business will be affected by your dividend decision, right? Your value of a business could go very down or it could go very high up. So that's why this dividend decision is also very critical. How much dividend you are decided to pay each year to the shareholder, whether it's stable, 40% of income, 30%, or it's changing up and down, it's going uncertain, that's stable. So all these decisions you have to take as a finance manager. So let me summarize this. What are the three key decisions? Investment, financing, dividend. Okay, next. This picture I want to show you, right? This chart. All the three decisions are there in this chart. If you understood this, I promise you, you have understood the whole syllabus of FM. Because the whole syllabus of FM is only this. Everything is presented here only. This one picture, that's it. So you understood this means you understood the whole concept. Okay. So the first decision, financing decision. Money in, if you can see the arrow on the right side. Okay. Financing decision. Financing decision means what? Money will come to the organization. Because through financing you are taking finance, right? You are taking finance from somewhere. Maybe from the bank, maybe from venture capital, maybe from your creditors, you are taking goods on credit. Maybe you are taking an overdraft, maybe you are taking on leasing, right? Maybe you are borrowing from your friends or family. So whatever it is, from wherever you are financing, money is ultimately coming to the organization only, right? That is the whole purpose. So the main decision is financing, because when money comes in only you can spend out. Remember that. So financing decision is the first decision you make. Next only comes investment and dividend later. Because if you have to invest also, money will go out definitely, because you have to invest in non-current assets or for working capital. For dividend also money will go out, because ultimately from the profit, dividend you are paying to whom? Shareholders only. So money is going out only. Only in your financing decision money is coming in. And finance, how can you finance? Through debt or equity. So there are two things, debt or equity. So debt or equity is a way of finance. Both the arrows are showing towards finance, a finance to a company, right? Under financing decision, you can see first is sources of finance. So we are going to study sources of finance. Bank overdraft, bank loan, leasing, hire purchase, factoring, invoice discounting, all those things. This all are sources of finance, right? We're going to study them in detail when we go to sources of finance. Now, can you understand the connection between how those chapters are built up? Everything is related, everything is integrated. So when you're studying, also study it as a whole. It's just one part of it. Source of finance. Okay. Don't study it in isolation. It's not right. Everything is interrelated with each other. If somewhere decision goes wrong in one area, remember it will affect everywhere. Let's say, for example, your financing decision went wrong. You have taken the wrong sources of finance. What happens? Cost of capital will be high. Your risk will be high. What happens? Because of those, you will not be able to pay dividend also. You will not be able to invest in non-current assets also. So investing decision also you are failing, in dividend decision also is going poor. Ultimately, the whole company will suffer. The value also will suffer. They will struggle to manage. So you see, everything is related. investing, financing, dividend decisions. All these three decisions are related to each other. Somewhere you make mistake, it will recur on the other two decisions also, it will suffer. Remember that. So when you're studying, also study like this, that how this is related to this, how this one is related to this. This makes it more interesting for you to study. It also makes you more aware. You know what you are studying, where you are at the moment. So try to zoom in and zoom out, right? Sometimes you have to zoom out, sometimes you have to zoom in, right? Once you have studied one chapter or somewhere in depth, in detail, later come out of it and try to relate it or link it with the whole what do I say, syllabus, and see how it fits there. That is the beauty of it. Then you will start to find it more interesting, right? Because if you just try to memorize all those things, how much can you memorize, man? I mean, it will not work out. Definitely it will not work out, right? So under financing decisions, sources of finance, number one, cost of capital. Yes, cost of capital, it will affect based on your debt equity proportion, how much debt you are taking or how much equity you are taking, right? Next, capital structure. Capital structure means what proportion of equity and debt are there. Risk, it affects your risk also, financing decision, because higher your debt, more riskier you are. Remember that, because you have to pay more interest to the bank. We are taking a loan on that. So in that case, dividend is more safe, because dividend, if you make profit, you pay. If you don't make profit, you don't pay. But debt, irrespective of whether you make a profit or not, you have to pay to the bank with interest. So remember, that's more risky. So risk management, remember that risk management, that also comes here. Next, let's go to the investment decision, where money is going out. I'm sorry, I went to the next slide. Okay, so investment in non-current assets and working capital, two areas where investment decision is important. So investment appraisal, working capital management, and risk. As you can see, three sections itself is out from this two. Next, we have dividend, right? Dividend, whether business valuation and efficient market. So the whole syllabus is based on this only. That's it. Next, this is the last part of this section of this right, under the purpose and nature of financial management. So we are going to find the differences between these three and some similarities also. What is it? Financial management versus management accounting versus financial accounting, right? We are going to find out the differences and similarities between financial management, management accounting, and financial accounting. Management accounting and financial accounting you must have known from your F2, F3, right? Or I guess it's F. Management accounting, I think, is F1 or F3. I kind of forgot. And then financial management, right? And financial accounting. So, what is management accounting, right? Learn the definition. Don't memorize the definition. Just know the keywords. That's enough, because you don't have to write these definitions. No one will ask you what's asking what is management accounting, what is financial accounting. The reason why it is given here is for you to know how it is different from financial management. Otherwise, what happens is most of this, some of the students think that financial management is same as financial accounting. They started thinking like that. They get confused between the two, right? So management accounting is different, financial accounting is different, financial management is different. First, you have to understand this. That's why clear distinctions needs to be made between these three. So management accounting is concerned with providing information for the more day-to-day functions of control and decision making. What happens? Day-to-day functions. The keyword is here. They provide information for day-to-day. It's more like internal, not external. Okay? And based on that, they make decision. Next, we have financial accounting. What is financial accounting? Same, providing information only. But this is about historical results of past plans and decisions. Something to do with past. They're just giving information on that. Next, management accounting and financial management are both concerned with the, now you see the similarities between management accounting and financial management. Both are concerned with what? Uses of resources to achieve a given target. Right? Management accounting also uses some resources. Financial management also uses some resources to achieve a target only. Okay, and much of the information used and reported is common to both functions. Next, this is also same continuation of that. The main differences is in the time scale, right? What is the difference between time scale? Financial management is concerned with long-term raising of finance. Remember, financial management is more into long-term. Okay, raising of finance, collection and control of resources. It involves targets or objectives that are generally long-term by nature. So even the objectives and targets are also long-term by nature. While management accounting usually operates within a 12-month time horizon. So if you have to find the difference between management accounting and financial management, it is the time scale. Financial management is long-term in nature. Management accounting is short-term in nature. Next, management accounting is concerned with providing information for more day-to-day function of control and decision making. We saw that in the first slide. This will involve what? All these things are there in management accounting. Budgeting, right? Because budgeting we do day-to-day, on monthly, or we have quarterly budget. Then we have cost accounting, controlling cost. Variance analysis, we find the variances, right, between the budget and the reality. Evaluation of alternative uses of short-term resources. Next, this is also continuation of this. Financial accounting is not directly involved in the day-to-day planning. Remember this. Control and decision making of an organization. Rather, it is concerned with providing information about historical results. So the word important you have to remember is historical results, not day-to-day information. Okay. So its purpose is to keep the shareholders and other interested parties informed of the overall financial position of the business, and it will not be concerned with the, see, when you're studying, don't just study what it is concerned with, you also have to study what it is not concerned with, because it will come in your multiple choice questions, objective test questions in section A or section B. There you have to write sometimes, right? So, and it will not be concerned with the detailed information used internally. So it's not bothered about internal information which are detailed, right, which are used by management accountants or financial managers. Who uses internal information on day-to-day basis? Either management accountants or financial managers, not the financial accountant. They are, right, their job is to give a snapshot of the financial position on a yearly or a quarterly basis. That's it. Next. So with this I will end this, the purpose and the nature of financial management, and also the differences with management accounting and financial accounting, right? So with this I will end. This is the last. What is it? So these are some differences you can see on the task and the jobs of this three strengths: financial accounting, financial management, and financial accounting, right? So review of overtime spending. Who does it? Overtime spending, management accounting, not the other two. That's why there's a tick mark. Management accounting. Why? Because overtime spending, budgeting, they have to do. They have to pay payroll. Management accounting. Depreciation of non-current assets. Definitely it is financial accounting. They will show depreciation because they have to show the financial position. It has nothing to do with management accounting and financial management. Establishing dividend policy. Dividend policy, just now we studied in this video. It is one of the key decisions of financial manager. So financial management. Evaluating proposed expansion plan. Again financial management. Investment decisions. Apportioning overheads to cost units. Who will do that? Management accounting. Identifying accruals and prepayments. Financial accounting. So with this we have I end this video here. What is upcoming next? So the next is the relationship between corporate and financial strategies. Now please before you go, all my videos will be there in the playlist, so check the playlist. It will be named as section A, financial management function. So you will go there and you will see all the videos will be there. It will be there in order, so you can see, I will be numbering it. You can see 1 2 3 4 5. So based on that you can see the videos, so that there is no confusion for the first time viewers who view my video. They will know the order, they will know the sequence of it. I will give it in the playlist and it will be in that order. So thank you and take care, and see you till my next video.